So Chris, you mentioned the GDP number and why it was lower. And so some people dismissed that GDP number because consumer was still pretty good and certain metrics of regular consumer spending were still pretty good. But it looks like a lot of the factors that led to those positive numbers have turned south here as we head into we're almost midway through the second quarter at May 10th. Second quarter will end at the end of June. So we'll see how that shakes out, but we don't get those numbers until the end of the quarter, right? So it's hard to really tell. So we have to look at employment and other numbers that kind of signal what we're going to see in July when the quarter is over. So it's getting mixed signals. But the Fed is very concerned about inflation, and inflation is one of the stink bombs in the economy that could easily slow things down. And we're seeing people already make those kinds of decisions. The surveys have been that when oil prices and gas prices get to the levels that they're at, people will make decisions to not travel. Maybe you don't do that cross-country driving trip this summer. Maybe you just go to the next state, or maybe you just don't stay in a hotel and you just do driving trips around home, but not cross-country. So people are now making decisions based on inflation, and they're going to be raising interest rates. So the Fed already raised interest rates once at 50 basis points. There was fear that they were going to raise it at 0.75. So they pretty much came out in their release as they did the 50 basis point increase and said they're not going to raise at 75 basis points a time, but they're going to raise 4 times 50 basis points. That's what their expectation is. So they're signaling it, and that's why the market's reacting. So apparently we're going to get 3 more interest rate increases, but they're not doing it all at once. But in effect, by announcing it, they kind of did it all at once. So one of the things the current Fed does that the older Feds didn't do is they signal everything that they're doing. And you can debate whether that's the smart thing to do. It's like, when you're a military general, do you tell the other side what your next move is? You don't. When you are making decisions for an economy and people are going to react to what you say, do you tell everybody what you're going to do in the future? Maybe that's not the best strategy, but the current Fed does that. Yeah. 4 increases, Chris.
Yep. Yeah, exactly. I mean, that's what they're forecasting now. And, I think you had a really good point, Brian. I mean, I think some of the numbers that we've seen that are past, I think the U.S. economy added 428,000 jobs in April. So the April number looked pretty good. That was the 12th straight month of gains above 400,000. So overall, that looked, you would say, hey, we're still rocking. The job market's strong. But we haven't gotten the May numbers yet. And if that starts to slow and we have a slow June, overall, the Q2, we could see, the job market start to deteriorate. So that's kind of one factor that we don't know what's going to happen. But in the where you're seeing inflation really creep in is the average hourly earnings. They came out, they rose by 5.5%, 5.5 in April. But the inflation number is 8.5%. So if you're one of those employees and you got a 5.5% raise, you effectively took a 3% downward salary adjustment effectively. So you're kind of losing money, and that's where I think we're seeing it playing in the economy as well. If you're down 3% relative to gas prices, if you're down to food, you have to crimp some of your spending. You don't have as much money to go out and spend. The other aspect we're seeing is personal consumption. So personal consumption increased 1.1% in March from February. So that's still Q1 numbers. But when you adjust that for inflation, it's only 0.2%. So on some of these numbers that look great, but once you kind of adjust and take that inflation out, they're much smaller. And one way that people are adjusting or compensating for this high inflation is they're levering up on debt. The Federal Reserve actually came out and in February alone, Americans increased their borrowing by a record of $42 billion. And I know in the last podcast, we spoke a little bit about the bank earnings. And I think on average, year-over-year, credit card spending was up about 29-30%, what a lot of these major credit card banks were kind of forecasting. So that's going to have a big impact. And that's going to be something that as interest rates continue to rise, that debt becomes more and more expensive. So that'll be really interesting to see what impact that has on the economy going forward. I mean, once again, we haven't really seen that impact yet. So the May, June, even kind of as we get into Q3, we'll see how that kind of ripples through the economy. And I'm sure that's a lot of what the market's trying to digest now is, what impact is this having on the consumer, and what impact is it having on the parts of the economy that are still holding up now. The last thing I'll mention, and this is where we've seen it kind of highlighted the most, I want to say, in the market is mortgage rates. So right now, the average 30-year fixed mortgage is 5.54% for an average 30-year. The 15-year, which is usually a lot less, is 4.75%. I'll even mention personally, about a month and a half ago, we locked in an interest rate for a home purchase that we did, and we locked in at 4.49%. So that's over about a month and a half, you had an over 1% rate increase on a 30-year fixed mortgage, which is very drastic. So we need to see some stabilization, I think. And as we kind of get that stabilization, things will kind of start to kind of bottom, I think. And we'll start to get that volatility will start to lower, and things will start to steady out, I think.